and welcome to our class of FAC 1501. Today we'll be looking at unit number 8 and unit number 7, which deals with the inventory and credit transactions. That will be our tutorial for the day. And but we'll also look at things that we've done in the past as well, where we'll start with those items from number 1 up until number 13. And the very first, I want us to. Last week we've had an assessment where we went and write the assessment number 1, which constitutes 10% towards our year mark. I want to check with us. How did you find it? What areas did you find most challenging? Let's see by the raise of hands, those who want to share. How did you find the assessment, and what were the most challenging parts of the assessment? Let's see by the raise of hands.
Yeah, no, I actually failed this. Exam in the first semester, so I don't know what's going on. I'm gonna be honest. I don't know what's going on. Please help because this thing is very confusing, and yeah, I've been struggling this whole time. Please help if you can.
How did you fare on the last week's assessment?
No, I didn't write it last week. I wrote it in the first semester. Are y'all doing semester two stuff, or are you doing semester one stuff? Because this looks like stuff from semester one. Well, I was in semester one when we did something like this.
Content is exactly the same. Okay, thank you for that. There was an assignment which was written last week. Did you write?
Oh, yes, I did.
How did you do? What
Uh,
areas did you find challenging?
so the area that I find challenging, it's I think it's the second question, like just before the text thingy questions. That's the question that I'm still struggling with, but I feel like I did really well because I got 80%. So yeah, I just need to polish. I think it's unit 3. Yeah, there are some concepts that I'm struggling to understand there.
Okay, thanks for sharing. But what areas did you find the most
Eating
challenging
all,
on the assessment?
yes, yes, sir. So I'm a bit worried about how I'm gonna end up doing it because in the first semester I struggled with QMI 15100. Now it's FAC on the second semester because I'm getting exposure to subjects I didn't do at high school.
Okay,
So that's my experience I'm currently having, and it makes me
okay,
feel a little bit overwhelmed.
okay. No, thanks for sharing. And remember,
Oh,
15 FSA 1501 is the first level basic accounting. So there is no expectation that you would have done it before. I think, of course, for those who have not done accounting before, it will require that you put more hours and more effort in terms of the learning material and the quizzes and the assessments that we provide, so that you can grasp the content.
I wanted to ask if for this particular module, are we gonna have to do it all the way throughout the whole degree, or is it just gonna be for the first semester?
What qualification depends on the qualification. If you are doing qualification which has accounting in level 1, 2, 3, you will do it in all the levels. But if you are doing something else which only requires accounting 1, you might do 1 or 2 accountings in the first level.
Okay. Do you know where I can check to find out that information?
Yes, on the information brochure for your qualification, you will be able to find find your qualification, then just check what modules are contained on the first year, second year, and third level. Then see if accountings are optional or elective, or what level are they.
Okay, thank you, sir.
Thank you. Thanks for sharing with regards to the assessment. I think the only person who was specific in terms of what did they find most difficult was a person who shared on about the unit number 3, which is basically the introduction to financial accounting, and aspect to understand on the introduction to financial accounting is the accounting equation itself. assets equals to Assets equals to equity plus liabilities. And the most important slide that I've presented last time, and I think in each and every class I will be presenting it, is this slide, which we must master, and we must understand that we have we have basically four groups of accounts, of which those four groups they are depicted here in the screen. And the main ones, it's assets that increase on the debit side and they decrease on the credit side. Liabilities that increase on the credit side and they decrease on the debit side. Equity that increase on the credit side and they decrease on the debit side. The expenses that increase on the debit side and they decrease on the credit side. The income that increase on the credit side and they decrease on the debit side. And if we master this particular understanding, I think we're halfway to pass accounting at all levels if you master this understanding. And if you can look at this slide closely, you will notice that it seems like uh, all these three accounts on the right, the liabilities, equity, and income, they all increase on the credit side. And these two that are on the left, the assets and the expenses, they increase on the debit side and they decrease on the credit side. If you master that, you are halfway to pass accounting. So that's where we have looked at the assessment and what areas did you struggle with. And there is one particular area which we have already covered on unit number 4, but I've noticed on the group discussions that it seems like people are still struggling um with that particular section. Here is a very quick recap example of VAT. We have 10,000 rands, which is an amount excluding VAT. Who wants to tell us how do we calculate VAT on this amount, and how do we calculate the VAT inclusive amount? If we are given A, how do we calculate B and C? Someone please raise your hand and tell us how do we calculate that. If we're given 10,000 rands, that is VAT exclusive, and we are to calculate the VAT amount, which is B, and the VAT inclusive amount, which is C, which is 11,500 on the screen. How do we calculate that? Who wants to tell us? Please raise up your hand. Tell
Okay.
us, how do you calculate B and C? If you are given 10,000 rands, that is the amount exclude VAT. How do you calculate B and C?
Yes, sir. Okay, so you take the 10,000, then you multiply that by 0, 15, which is 15% basically as like as a decimal. And then once you multiply 10,000 by 0, 15, you'll get 1,500. And then now that you have your 1,500, now you can get your inclusive price. Then you just add the 1,500 to 10,000 and you get 11,500.
Okay. Pathichazo, how differently would you calculate it? Lisedi said is taking 10,000 rands and multiply it by 0.15 and he gets 1,500. Then he adds 1,500 to 10,000 and gets 11,500. How would you calculate it differently, Patho?
I wouldn't calculate it any different, but it's the same strategy. 10,000 multiplied by 15 over 100, since our VAT is 15%, and 15% means 15 over 100. Then you get your 1.5, which is your VAT. And then to calculate the VAT on the VAT inclusive, you will have to find your 15%, which is that 11,500 multiplied by 15% over the full amount, which is 100% amount plus the 15%. Then you're going to get your VAT out of the VAT inclusive amount.
Thanks for that, Patho. I like the fact that you are using the model that I like or that I prefer. 10,000 rands multiplied by 15 divided by 100, which gives you 1,500. 10,000 multiplied by 15 divided by 100, which gives you 1,500. Now, I want someone who can tell us, other than adding 10,000 and 1,500 to make 11,500, how different can we calculate 11,500? What is the other way of calculating 11,500?
Basically, you're gonna take the 10,000 times 115 divided by 15. Yeah. Divided by 100. I'm sorry about that.
Just repeat that.
10,000
Mm-hmm.
times
Mm-hmm.
115 divided by 100.
How would you calculate it differently?
I think I'm gonna calculate it like the very same way, but the logic behind the 10,000 times 115 over 100 is, since we are looking for the inclusive amount, we are going to say the amount multiply what we need over 100. So that's the logic behind it.
Okay. Thanks for that. So if you are given 11,500, how would you calculate the 1,500 and the 10,000? If you are given C, how will you calculate A and B? If you are given C, let's see by the raise of hands. Let's see by the raise of hands. If you are given C, how will you calculate A and B? If they say 11,500 includes VAT, now give us, remember for accounting purposes, the amounts that we put on the income, expenditure, assets, and income and expenditure accounts, they're all excluding VAT. So now, if you are given 11,500 and we say it includes VAT, how would you calculate the VAT amount and the VAT exclusive amount? Mbali?
So what you're gonna do is you're going to say 11,500 multiply by 100 over 115. Then you are going to get your exclusive amount. And then for the VAT amount, you are going to say 11,500 multiplied by 15 over 115. Then you are going to get your VAT.
Okay. And what is the thinking behind that? Why are you multiplying with all those figures?
Okay, so since we have like the inclusive amount, which is the original amount plus the VAT, and if we are looking for the exclusive, that is why we put the 100 over 115, because we are looking for the 100 in the 115. So I hope you get me.
Okay. Is there anyone who would calculate it differently than what Mbali is telling us? If you are given C, which is a VAT inclusive amount, and you are required to calculate A and B, which is the amount excluding VAT and the VAT amount. How will you go about calculating them?
I would divide the 11,500 by 115, and then I would multiply what I get by 15.
Oh, then, but that's not true.
It,
If you multiply by what you get by 15, will it give you the 10,000?
no, the 11,000 is going to give me the 1,500. That would be the VAT. And then you minus it from the 11,500. It gives you 10,000.
Let's just start slowly. So you will take 11,500 multiply by, or sorry, you said you divide by
11,500
mm-hmm,
divided by 115,
divide by 115. It gives you 100. Multiply
multiply the 100 by 15.
by 15.
It
Then
gives
it
you
gives you
1,500.
1,500.
That would be your VAT. You minus your VAT from the whole amount. It leaves
Or
you
you take
10,000.
1,500 minus 11,500, which will give you 10,000. That is correct. No, that's fine. Okay. Thanks for that. Thanks for that. Is there anyone who is still struggling about the logic behind these calculations?
Yes. Can you just please explain one more time how to get from C to B and A? So of the methods presented, which one is the simplest one, or does it not matter which one we choose? Because I still kind of
It doesn't really matter, but what I prefer is what I have written on the screen. I find it to be more understandable and more logical than the zero point what that the mathematicians usually use. So
okay.
the logic behind it, let me just start uh, from the beginning. If you are given A and you are required to calculate B and C, I think that's the easiest one. When you are given a VAT exclusive amount and you are
Yeah.
required to calculate the VAT amount and the VAT inclusive amount, what you will do is straightforward. You take 10,000, multiply by 15, divide by 100, or 10,000 multiplied by 15%, which will give you 1,500. Then you can
Okay.
then VAT inclusive amount, it means you are adding VAT on the gross amount which does not have VAT. Then you will take 10,000 plus 1,500. It will then give you 11,500
Yes.
in that regard. Uh, then you have all the three amounts. So now the slightly difficult part is if you are given the VAT inclusive amount, which is C,
A.
which is the 11,500, and you were to calculate any of the two figures.
Mm-hmm.
So what you are doing, let's do A. When you are recalculating A, or the VAT exclusive amount, you come and take 11,500.
Yeah.
Then you multiply it by 100 and divide by 115. The logic and or the thinking around this is just to say 11,500, or let me start here, is just to say 10,000 is the gross amount, which is like 100%. It does not have VAT or
Mm-hmm.
any other thing as yet. 11,500, it has been added an additional 15%. So it has some 15% on it. Hence, when you are dividing by 115. When you are
Oh.
dividing by 115. And which one do you want? You are looking for 100% of the amount, which is multiplying by 100. Can you see that? Even when you are
Yes.
calculating the VAT part now, you are you are saying 11,500. It's already having it has been added the additional 15%, meaning when you are dividing, you are going to divide by 115. then the one you are looking for the 15%, which is the VAT. That's why you are multiplying by 15 in that
Yeah.
regard. You
Okay.
you can even on how to calculate the VAT inclusive when you only have 10,000, instead of
Mm-hmm.
adding the 10,000 and the 1,500, you can still use the same logic to say the 10,000, it's 100%, meaning I'm going to divide by
Yeah.
100, and then I'm looking for the amount which is 100 plus 15, which is the 115, for the amount which includes VAT. Then you
Yeah.
multiply by the 115. So the top part, or the numerator on this fraction, it's what you are looking for, and
Mm-hmm.
the denominator is to say the amount I'm using. What is it? Is the basis of the amount that you're using. If the
Yeah.
basis of the amount that you're using is the VAT amount, it means whatever you're doing, you are dividing by 15. Depending on whether you are looking for 100% of the amount, you multiply by 100, or you are looking for the 115 of the amount, you multiply by 115. So that is the logic or the thinking. If you think around that way, just take 10 minutes when you are alone. Try playing with different figures.
Yeah.
Try to calculate it, recalculate the other, and think about it, recalculate the other. Then you should get it right.
Okay. Thank you.
Okay. Thanks for that, colleagues. I hope we grab this, because I think this is a tricky part of accounting, which is almost mathematics. But once you grab it, you have grabbed it. You will not really struggle with accounting going forward. There is a concept of gross profit which we're going to look at today, which uses very identical principle, but we'll have a look at it shortly. Okay, let's move over that and look at um, the common concepts on the topics that we'll be learning on these two study units, number uh, 7 and 6. Here are the concepts that we have listed on the screen, which is the inventory systems, the perpetual inventory system, the periodic inventory system, the periodic inventory system, the first in first out inventory valuation method, the last in first out inventory valuation method, or LIFO, the weighted average method, and the cost of sales, the markup on cost of sales, trade payables, trade receivables, and general journal. I want those who are saying there is a concept here on the screen that I do not understand, to raise your hands. When I point you tell us which concept here we listed on the screen you struggle with, or you do not understand.
All
Struggle
of
with.
them accepts trade payable, and trade receivable payment.
Okay, all of them except trade receivables and trade payables. Thank you for that, Mbali.
So it's the periodic inventory system.
Periodic inventory system.
Yes,
Okay,
and the cost of sales.
and the cost of sales,
Yes, and the general journal.
and the general journal.
Yes,
So, so the markup on cost, you do understand what it is.
no,
Oh, but you didn't mention it.
I didn't see it. Sorry.
From perpetual inventory system up until general journal. Okay, noted. The sorry, Shange.
Good morning, sir.
Morning.
Uh, uh, I understand the cost of sales, trade receivables, trade payables, general journal, first in, first out. Besides them, I don't understand the other ones.
Okay, okay.
Yes.
No, thank you so much for that. Um, okay.
I don't understand the first in and first out method and the last in and the first out method.
The inventory valuation methods. Okay. I think almost everything is not being understood except trade payables and trade receivables. So now let's get hands of those who want to tell us the first two. What is the perpetual inventory system and what is the periodic inventory system? Let's get hands of those. And those whose hands are still up after talking, you risk being asked to explain. If you don't lower your hand, DT and Ditsepu, Shange, and Nyakalo. So let's get those who understand what is the perpetual inventory system and what is the periodic inventory system, and to tell us. Please raise your hands, those who understand, so that you can share with us. What is the perpetual inventory system and what is the periodic inventory system?
Okay. So I'm taking a wild guess because I'm also feeling like the last student that was on right now. I also feel blank a little bit, but what I do think about perpetual inventory system is that it is the taking stock of the items that are in the store, um like after a specific time, and then periodic, no, perpetual is like all the time, and then periodic is after a specific time that the stock is counted, I think.
Okay. I think you are almost there, but I think the periodic were on the money, exactly what it is. But the
Okay.
perpetual, maybe it requires further explanation. Yes. What is
Um,
your understanding of what is perpetual inventory system and what is periodic inventory system?
With perpetual inventory system, I think we transfer the total of the settlement discount received from the account to the cost of sales account. And then we total the debits and credits side cost of sales account. And then we calculate the new balance of the cost of sales account. And then we transfer the balance of the cost of sales account to the trading account. And then from there we look the debit, if the debit side is bigger or the credit side is profit, something like that.
Wow. I think you went too far. I wanted the. I think you did explain the implications in terms of when either of the systems is used. How do you then account for it? However, the very basic. Thank you so much, colleagues. The very basic explanation will be on the perpetual inventory system. This is where the um, the inventory is tracked on a transactional basis, and cost of sales, it's calculated immediately when the item is being sold accordingly. So meaning when we are buying and selling, we are tracking our inventory on real time almost immediately. And cost of sales is also determined immediately per transaction. That is a perpetual inventory system. Everything that Tibato has explained in terms of how to account for it is correct. And the periodic inventory system, this is the system where inventory is not necessarily tracked per transaction, and the cost of sales is not necessarily calculated immediately per transaction. The entity will perform what we call the in periodic inventory count. It's either monthly or at the end of the quarter or at the end of the year. Most companies they do it the stock count at the end of the year. When they do the stock count, that's when the value of the inventory is determined, and the cost of sales of all the goods and services that have been sold during that particular reporting period is determined accordingly. First in, first out, last in, first out, and a weighted average method. Who wants to tell us what are those? Nyakalo, what is first in, first out? What is last in, first out? And what is weighted average method of inventory valuation?
No, so I had mentioned that I don't know the truth.
But your hand is still up.
Oh, I didn't see, sorry, I didn't see, sorry.
Shange, do you want to tell us what is the first in, first out, last in, first out, and the weighted average inventory valuation method? Shange?
I'm sorry, I was still turning my microphone on. The only one I know, but not very well, is the first in, first out method.
Yes, tell us, what is it?
The method, I do not know the method they use, but like I know, for example, when they use items like, for example, bread. If I'm not mistaken, please correct me.
Oh, sorry, I
Hello.
thought you were still continuing. Is that is that your explanation?
No, I'm just saying that I do not I do not know exactly the method, but I know when they use it with items like, for example, bread at shops, the
But
first in first out. I don't know
what
if
will be
I'm
the
wrong or if I'm right.
what will be the reasoning there that the bread that was baked yesterday will be sold first before the bread that was baked today? That does
Because
not sound right.
they don't
People
want
want
to.
fresh bread, isn't it? The one which is still hot baked today. Am
Yes,
I wrong?
yes, people want fresh bread. That's why when we go to shops, because we are used to that method, we go, we pick the bread that's behind, because they put the one that they baked yesterday on in front, so they can finish the stock first before they can even finish the one that they baked today.
Hey, thank you so much for that, Shangi. I think I like the
Yes.
fact that you are personalizing this this accounting. Anele
Because
Mashovo, what is your explanation of first in, first out, last in, first out, and the weighted average inventory valuation method? Lisedi?
Okay, so my guess based on the bread example is that if it's first in, first out, I'm guessing this just means that you take inventory continuously as like the stock is taken out. Then if it's last in, first out, I'm guessing this just means you check what's left and then you take inventory, or if it's cleared out, then you just take inventory of that. That's my guess.
Okay. And last in, first out? Oh, sorry. And
Yeah,
the weighted average? Sorry, the weighted average. Sorry.
weighted average. I'm gonna come with the math here. I'm just gonna assume that you're just taking an average of like the weight of like your inventory. That I have no idea.
Okay. Puselo, so what is your understanding of the three items?
Good morning. So the first in first out method it's where we take the last sorry, yeah, okay, it's where we take the last inventory and then we sell it first. And then the LIFO it's where we take the newest inventory and sell it first. And then the weighted average method it's where we take the total number of goods and divide by their quantity or unit.
Okay. We will look at this. Thanks for that. We'll look at this in detail later on today. However, at a very high level, this is just the thinking around how the inventory is being handled, or the assumptions around how the inventory is being handled. On the first in, first out, the assumption is that the inventory which has been received first, like our first lady has indicated earlier on, that bread that was baked yesterday will be put in front so that it will be sold first. The one which is baked today will be put at the back so that it will be sold last. That is first in, first out. meaning the first inventory to arrive is the one which will go out first. That is the first in, first out. And on the last in, first out, the assumption is that um, um, the inventory which has arrived last will be the one that will be sold first. So let's say maybe different to our bread scenario. Let's say you are a Woolworth and you are known for selling fresh products. Now, if you are having hot bread and cold bread and you're Woolworth and you want to maintain you from for being known for selling fresh products, what you're going to do, you will put the fresh the fresh one in front, and the other one, the old one or the a cold one at the back. That's when the last in first out goes, meaning the bread that we would have baked today will go out first. Then when it's finished, that's when we can start selling the one which is no longer hot, the one that we have baked yesterday. So last in first out is what we have received last goes out first, and what we have received um, 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 earlier on, I mean later on, will then go out last. So first in first out, what has arrived first will be sold first. Last in first out, what has arrived last will be sold first in that manner. And the weighted average method here, remember, these are the method of calculating the cost or the value of inventory. Remember, when we baked our bread yesterday, you will find that the flour that we've used yesterday, we bought it for 5 rands per kg. But remember, the commodities prices, they change on a daily basis, sometimes on a minute basis. The flour that we've used to bake today, the price might have increased to be 7 rands. So now, on the weighted average, instead of assuming that what I baked yesterday, it costed me 5 rands, and assuming that what I've baked today, it has costed me 7 rands. You kind of combine and say, no, 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 no. When I was baking, I was not choosing whether is this yesterday's flour or is this today's flour. Somewhere they could have been mixed. So what you are doing there, you are taking the average of how much did I have yesterday, and then calculate their value based on their 5 rands yesterday, and how much did I have today based on their today's 7 rands. Then you average the two, then you get your total value or your total cost of that particular inventory. We're going to look at this in detail not so long. The cost of sales and the markup is, who wants to tell us what is the cost of sales and what is the markup?
Okay, so I'm thinking cost of sales is just how much money does it take for you guys to sell the bread. So when you guys stock your bread, how much does it cost? When you stock your tools and stuff, how much does it cost and all that? Then the markup on cost is just an additional amount of money that they add on top of the price. It's like basically the price that you sell it at when you're like selling an item or like a service. Well, I don't know if services have markup, but like items usually have like a markup on cost. And then yeah, I guess you use that to make up for I guess your cost of sales and how much it costs to like get the inventory and all of that.
Okay, thank you for that. Uh, and I think you have mentioned it properly. I don't think there is much to add in that regard. The cost of sales is the cost of the products that we have sold, and the markup is just the difference between what the price that we have sold those products for and what it has costed us. That is basically the markup in that regard. Trade receivables and trade payables, I think everyone said they kind of understand what is that. We're not going to repeat, but just high level. Trade payables is monies that we owe our suppliers in the main. It's what we owe. It's a liability that we owe. Trade receivables is an asset. It's monies that are being owed by our debtors or our customers. Monies that our customers owe us. We call them trade receivables. And the general journal, I think there is someone who has mentioned that they don't understand what is a general journal. But in any way, general journal, that's where we record all those transactions that cannot necessarily fit in on any of the subsidiary journals. Remember what we've done last week, the cash receipts journal, cash payment. Well, today we're going to look at the sales journals, the purchases journals, sales returns, and purchases returns. Transactions that cannot fit in any of those, they get recorded in the general journal. In that regard. So let's move over from the common concepts and look at the inventory valuation method. We have shared the Excel spreadsheet, which contains different ways of valuing the inventory, and those different ways of valuing the inventory are contained on the Excel spreadsheet. I hope we have looked at them and tried to calculate on our tutorial or to the class. We only look at the difficult sections that we have encountered so that the process can be fluid. But on my screen here, I'll just quickly take you through the first part. This is, we have designed a dummy inventory sheet. This is more or less what you will see on an inventory sheet, but of course it will be on a computer program. It will even be called an inventory report or whatever that you will call it. So we have three products that we have purchased here in different batches. These are the batches that we are assuming that we have purchased. Batch number one, we have purchased Handy Andy. Batch number two, we have purchased another Handy Andy. And batch number three, we have purchased Vanish. Handy Andy, it's remember, we have created our dummy company, which is a cleaning company, which keeps the inventory of cleaning material, and it also sells the cleaning material. So ND is a cleaning material, Vanish is one of the cleaning material as well. These are just the product, the dummy products. And on batch number one, we have bought the quantities, how many we have bought. We have bought 100 NDs. On batch number two, we have bought 50 NDs. Batch number five, we have bought 30 vanishes. And this is the cost excluding VAT. On batch number one, we have bought them for 80 rands per item or per quantity. And on batch number two, we have bought them for 90 rands per quantity. And batch number five, we have bought them for 50 rands per quantity. Then the ones that are coming from batch number one, 10 were returned to the supplier wherever we bought them. And the handy andies from all the batches, we have sold 50, and the vanishes we have sold 10 of them. And the selling price, the handy we sold them for 104 rands each, and the vanishes we have sold them for 65 rands each. I'm explaining this so that we can understand where we're coming from in that regard. And the prices exclude VAT. The prices exclude VAT in that regard. Remember what we have just learned recently, how to go back to calculate the VAT, how to go back to calculate the amount including VAT. Same principles apply. So now we had a question. The first question was um, um, oh sorry, this is on the next one that we're going to do not so long. Now wanted to ask, because we're dealing with the inventory valuation method, how do you calculate? Maybe I should have mentioned when we were dealing with the three methods earlier on. I've just went back to the slide where there are common concept, coming back to the inventory valuation methods, the three inventory valuation methods, as a side note quickly. the first in, first out, last in, first out, and the weighted average method to say the methods that are mainly used in practice most of the time is the first in, first out method and the weighted average method. The last in, first out is barely used in academia or for academic purposes. You will barely find the last in, first out inventory valuation method being used in that regard. So you will barely find. But for the purposes of being a proper accountant, you need to know how it works. However, you will barely encounter it. For academic purposes, we mainly use the first in, first out and the weighted average method. However, majority of the time, our questions or our assessments will be on first in, first out method. Let me go back to the Excel spreadsheet. So on the Excel, I want us to determine uh, how to value the inventory at the end of the period using the FIFO, the first in, first out, um, or the weighted average method. I want us to use any of those two. Before we talk complex figures and many things, let me ask a very simple question. Please raise up your hands and tell me if we have bought 100 varnishes on the first batch and bought another 50 on the second batch, we returned 10 to the supplier and we sold 50. How many varnishes are left in inventory in our warehouse? If we have bought 30, sorry, the other one is the ND. The other one is varnishes. If we have bought 30 varnishes and we have sold 10, how many are left with in our warehouse or in our inventory? Let's see by the raise of hands. Just tell me the numbers. How many ND are left and how many varnishes are left? Let's see by the raise of hands. Yes, Patricia.
So for Handy Andy, we bought 150 and then 10 was returned, which means we had 140 in inventory and then we sold 50 and then we left with 90. And then the other one, the Vanish, we bought 30, we sold 10, which means we left with 20, sorry.
Okay, thank you so much for clarifying that. So, for the Andy, we're left with she said 90. We're left with 90, and for the vanishes, we're left with 20 because we have sold 10 and we're left with 20. Is there anyone who dispute these two figures that Patu has just given us? It seems like there is no dispute. So now my question is, um, um, my next question is, how many did we sell? How many? Uh, but that one is simple. It's straightforward. We sold 50 and we sold 10 on the other side. So 90 and 20. So if we were to value our inventory at the end of the period using the FIFO method, who wants to tell us what is the value of these 90 that are left? Who wants to tell us that? And what is the value of these 20? And then we bought them for the vanishes, they were 50 rand each. And sorry, yes, the vanishes were 50 rand each. And the Andy, the first batch was 80 rand each. And the second batch was 90 rand each. Who wants to tell us how much did it, what is the value of this one? What is the value of the 90 that are left? And what is the value of the 20 that are left? Let's see by the raise of hands. Let's start with FIFO, first in, first out. Patu, tell us. You told us how many are left. I believe you are able to multiply by the cost. 90 Andy. How much do you think is their value?
I haven't reached that stage of calculating, but I'm gonna use my general knowledge according to this. So so if it's first in, first out, it means the first batch we had 90, and then the second batch we have 50, because we return 10, and then after selling 50, we're selling 50 of the first ones. So which means we left with 40 on the first one, which is gonna be 40 multiplied by 80, which is 3,200, and then 50 multiplied by 90, which is 4,500 plus 3,200. For handy Andy, what are we calculating again? How much the
We'll
cost?
calculate the value of the 20 that don't worry about my heading which says sold. We're calculating the value of the 20 that were left with in the inventory. What is the value of those items?
So if I would use the cost per item, it will be 7,700.
How do you calculate that?
I multiplied the 40 that is left on the first 100 by the cost, which was 80, and then the second 50, the 50 with the 90 that we bought it with. I'm just quite not sure which price you use, because yeah.
Oh, sorry. You started with the vanish. Now you are valuing the handy end, right?
I started with the handy Andy, and then the vanish, it's only it's 20 multiplied by 50
Mm-hmm.
that we have left,
Mm-hmm.
which is like 1,000.
Mm-hmm.
Yeah. I'm just not sure if that's how the calculation is done, because I haven't reached those chapters, but with the general knowledge, I think that's how you're gonna calculate it.
Hey, you're worrying me. But we're writing on Sarah this the assessment is opening on Wednesday. Eh? Must catch up with the lighting speed. But I think in general the principles are correct. Let's start with first in first out. Let's start with the vanish, which is easier. We have bought 30, we have bought 30 and we sold 10. Then we're left with 20 that we are calculating their value here. And the 20, in order to calculate what is the value of these 20 vanishes, of course we will take 20, which is the number of those that are left, multiplied by the cost, which is 65 rands per vanish accordingly. Then we got our answer, which is 1,300. The slightly complex one, in fact, even for the weighted average, because there are no many other variables, it is the same. And the slightly complex one, which is the first in first out, is that on this 90 that we're left with, we have to separate it in terms of what came from the first batch and what came from the second batch, which um, uh, since we're using the first in first out, meaning we're saying out of the 100, when we returned 10 first in first out, they were coming from those 100, meaning we're left with 90 from those 100. Then when we sold 50, what we are saying is that um, 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 50 that we sold was coming from that remaining 90. Then 50, so 90 minus 50, we're left with 40. So meaning from the first batch, we have 40. So then when we calculate how much is the value, meaning we're going to say 40 multiplied by what we bought it for. The first batch, we bought them for 80 rands per batch, meaning multiply by 80 rands. Then we add the remaining. The remaining of the other 50, meaning it comes from the second batch, which will then take 50 multiplied by 90, because the second batch we bought it for 90. That's what Pat was explaining, and that's how exactly it is. When we are when we're using the first in first out, it's just trying to create logic to say whatever we received first, when we are returning and when we are selling, we sell from those first, then whatever is remaining comes last in that regard. And the weighted average works slightly. Weighted average, remember, is saying we're left with 90 units, and those units, they're basically a combination of the two prices. There are various ways in which you can deal with this, but the easiest one is to look at the pricing. We are having mathematically to give you the same answer. You are having 80 rands and 90 rands, which you can combine it, get the average price, which will be 80 plus 90. It's how much? It will give you 85. That's the very shortest way of doing it, combining the two price and do the average. But the only disadvantage with that is that if it gets more complex and you have many other variables that are influenced by other things other than the sales, your answer might not be 100% accurate in that regard. That 85 then when you are calculating is just a matter of saying 85 multiplied by 90, which will give you the figure. The preferred method is to use the totals in order to determine the average. The totals, how do you do that? First thing first, we are saying we have bought 100 with for 80 rands, where 100 multiplied by 80 it becomes 8,000. And the second ones we have bought 50, and we bought them for 90 rands, and then we got 4,500. Then you add the two, you got 12,500. Then you divide by the total. The total is 100 plus 50, which is 150. You see, there is a slight difference, but the more accurate answer, I mean, amount is the one that you use when you are using the totals in that regard. So you got 83, meaning 83 rands per unit. It's your average, which you're then going to use there to calculate your value. We said we are left with 90, meaning we are going to say 90 multiplied by 83 rands. Then you get your weighted average cost, which becomes the value of the inventory at the end of the period. Before we move to the next leg, which is the determination of the markup and the cost, etc., etc., I want us to take a 5 minute stretch break. I've been told that my lectures are 2 hours long and I've never given you a break. How hello? How hello?
Good morning, sir.
Yes, morning.
Please clarify for me, when we calculating vanish, we used the selling price, but then when we were calculating for the handy andes, we used the original prices that we bought the handy andes for.
Thanks for that. It was an error. We're using the purchase price. Sorry, thanks for that.
Oh,
We are using
okay.
the purchase
Thank you.
price. It was just an error.
Okay, we are using the price that we bought the handy andes for.
Yes, remember we're determining the cost here. Yes,
Okay.
or
Thank you
the
so
value.
much.
Liso?
Good morning,
Liso?
sir, again in class. Good morning, sir,
Morning.
and class again.
Morning.
I just want to
Ye-
ask, is there going to be a recording for this whole
Yes,
class?
the,
Because I missed
the
like 30
recording
minutes.
the recording will be shared after the class. Thank you for that. So it's now quarter past. Uh, let's come back in 5 minutes time, which is 20 past. Let's come back 20 past. Just 5 minutes stretch break. I've demonstrated how. Welcome back, welcome back, welcome back. I've demonstrated how the inventory valuation methods, different methods, works, of which we have looked at the weighted average and the first in first. We didn't do last in first out, but it works slightly similar to first in first out. The only difference is that you will assume that the last two units were sold first, but the calculations around it works exactly the same. On weighted average, what I've shown you there, the calculation using the totals, that is the most preferred method. Even though it can be a little bit longer if you are having different purchases and sales at different dates. However, is the most preferred because it's more accurate than any other mathematical shortcuts that we have looked at as well. I'm showing you the other one to say, of course, it's almost like cheating to say if you are having a bigger accounting question where time is not in your side, you can demonstrate how you would calculate it in order to get marks. But for further calculations purposes, you can more or less use the cheat method, which will give you almost accurate figure without having to go far. However, the disadvantage with that, you might not get the full marks. But if you are running out of time, you can use that as long as you put in the assumptions that I'm assuming that my weighted average cost is this much, and you use it consistently going forward in your calculations in that regard. So we'll move over to the determination of markup on cost. We'll use the very same figures, assuming that they are accurate, of which I've already done the structure at the bottom here. If we were to assume that our markup it's 30%, markup is 30%, the one which I've highlighted there in gray. Let me highlight it in yellow. If we were to assume that our markup is 30%, it means when we are calculating the cost of sales, or maybe let me mention this on page number 214 or PDF page number 10 of your study guide material. That's where you will find what I've just plugged here. You will find the further detailed explanation on how the markup on cost works. However, in terms of the formula that someone has given us earlier on in the class, um, what I've highlighted there, um, cost of sales, they are the figures. Cost of sales, um, it will be 100%. The markup will be 30%, and the sales amount, it means the sales amount is 130 because sales plus markup, I mean cost of sales plus markup, it becomes the selling price, which would be like 130 as indicated there, and the markup percentage is 30% in that regard. We can use the figures to play around that particular concept to say 65 rands per vanish is the selling price. We have bought them for 50 rands. If you ask how much is the markup, markup is what we have sold it for, which is 65 rands, minus what we have purchased it for, which is 50 rands. Markup is your 15 rands. Then the markup is almost like, I don't want to call it profit because in accounting profit means something else, but it's almost like that little extra that you make between your selling price and your cost price, or the difference between your cost price and the selling price. It becomes the markup, or that additional fee that you give yourself in addition to the cost of however much it has costed you to acquire the goods and services. Whatever that you add on top of your cost, in order to determine your selling price, it becomes your markup in that regard. And moving on the periodic inventory system. Remember, Lisedi explained to us earlier on, and she said to us that in the periodic inventory system, they they calculate, uh, they do the stock count at the end of the reporting period, and then determine um, um, how much is the, what do you call, how much is the value of the inventory at the end of the period. So meaning, um, when it comes to what we have just calculated, yes, the value of the inventory at the end of the period, when we said we're left with 90 handy and 20 vanishes, they were going to do is that they were going to physically count there in the warehouse instead of calculating the way we've calculated. They were going to physically count there in the warehouse, and then use one of the three methods to determine when they find their values, because many things could have happened. Some dubious employees could have stolen. You'll find that in the system you're having 90 NDs, but when you do the physical count there, you find that the NDs are no longer 90, they are 45 or whatever number. The others are stolen, and inventory do get obsolete as well. They pass their expiry date, where you find that they are no longer usable, or they're no longer in good condition. You can no longer sell them anymore. So now you have to dispose them anyhow you want to dispose them. Maybe you throw them to you dump them in the landfill site, or you sell them to the just before shop. I hope you know the just before shop, which sells items that are just before expire or just before their use date. Whatever you do, so that 90 there and that 20 there, those are theoretical inventories. The inventory can be different in your warehouse. So the periodic inventory system, um, system of accounting for this inventory, it assumes that we're not quite sure as to how much inventory we have up until we go and count it. And the good part of it is that majority of the time, in terms of how much is the closing inventory, we are going to give you the value of the closing inventory. Sometimes we can give you the quantity, and we test you in terms of the FIFO and the weighted average as to whether you understand how to calculate those values. But majority of the time, we're going to give you the value of the inventory. And cost of sales, as we have indicated, it does not go per transaction here on the periodic inventory system. It gets calculated at the reporting period, meaning at the end of the month or at the end of the year, when we are reporting. Then we calculate it. How do we calculate the cost of sales? There is a formula there which is contained on that page, which I've shown you earlier on in your study guide. We use opening inventory, meaning value of the inventory at the beginning of the reporting period. We add what we have purchased during the period, add the purchases, the value of whatever we have purchased during the period, and we minus the closing inventory, the value of inventory at the end of the period. So now let's quickly calculate the cost of sales. Opening inventory, in our examples, it was zero. There was nothing. The purchases, how much did we purchase? Let me scroll up a little bit. Remember, we have purchased 100 handy Andes for 80 rands each, and we have purchased the other 50 for 90 rands each, and we have purchased 30 for 50 rands each. Who wants to tell us what is the value of our purchases? Let's see by the rest of it. Please calculate quick and tell us how much is our purchases. Don't forget to minus the 10 that we have returned. It's not a tricky question. It's just a time-saving question to say someone calculate for us and tell us the value. How much? Let's see by the raise of hands. Those who are done. You calculate the three. You calculate the 19 up times 80. You calculate 50 times 90. You calculate 30 plus 50, and you add all the three totals. How much?
13,200.
13,200.
Yes.
Okay.
90
We'll
times
ask.
80 plus 50 times 90 plus what's the last one? 30
It
times
was 30
50.
times. Yes. We'll assume that you are right.
Okay.
13,200. And the value of the closing inventory, this one on the periodic inventory system, we're going to give it to you. So let's assume that it will be the same as the 8,000 that we have calculated earlier on, 8,700. Let's assume that it will be 8,700. So so we're saying the cost of the inventory that we have sold, it's 4,500 in that regard. If we were using the perpetual inventory system, we were going to we're not going to use this formula. We're going to look at how many are the quantities that we have sold, and calculated the cost there. Then the cost will be here. But in any way, there will not be a need to do that, because remember, our perpetual inventory system, it works per transaction. It means when those items were being sold, we were going to calculate what was the cost of those. When the other ones get sold, we're going to calculate what is the cost of those with the general ledger T account on cost of sales. We'll have our total there, which will then come to be the cost of sales here. So let's determine the sales. Um, what we have sold 50 for 104 rands, and we have sold 10 for 65 rands. Can someone calculate for us how much is the total sales? 50 times 104 and 10 times 65. What is the total? What is the total? Let's see by the raise of hands. Let's say D.
5,850.
5,850.
That's what I got.
Doesn't sound right, but it's okay. We'll believe you.
Oh, wait, wait, wait,
5,000.
wait. Wait. So I want to ask before we continue, how did you get the 8,700? I missed the part when y'all did the
This
cost
one
FIFO.
we're going to give it to you because it's a what do you call, it's a periodic, sorry, yeah, it's a periodic inventory system. On the periodic inventory system, remember what is going to happen is that we'll go to the warehouse and count the stock to say,
Okay.
out of all the stock that we have, how much. Maybe let's not use the figure which is in here, because it might confuse you. Let's
Yes.
assume we came back, and after counting the stocks, hey, most of the items are stolen. We're left with
Yes.
inventory worth 5,000 rands. So we're not calculating this one. It will be given to you on the
Oh, okay.
periodic inventory system. So I explained earlier on that on perpetual inventory system, this item look different. The gray accounts will not be here. The gray accounts will
Okay.
not be on perpetual inventory. It will just be the cost of sales, of which the cost of sales will be a total from the GL account. Remember, we determine cost of sales per transaction. When we
Yes.
sell one handy to Mr. Jag, we are going to calculate the cost of sales there. But we're still going to have a look at it even today later on per transaction.
Okay, no problem.
But this is periodic inventory system. We're going to give you the value of the closing inventory, and you have just calculated the purchases for us, and the opening inventory will give you as well, or we might require you to do a mini calculation on the periodic
Okay.
inventory system.
Okay.
Yeah,
Okay.
and you said how much is your sale again? Sorry.
I cleared it. It was 5,820 or 5,850, something like that.
5,850.
Yeah, thank you.
5,000, 5,850. Okay. So sales minus cost of sales is what is called the gross profit. That's what I wanted to demonstrate. How is our cost of sales more now? What did we assume wrong? Oh, sorry, we reduce the amount of inventory, ne? Yeah, so sales minus cost of sales, it gives us the gross profit. That's what I wanted to show you. And sometimes they will ask you to calculate markup percentage. Markup percentage, it only means you, or sometimes gross profit percentage. It only means you come and take whatever your gross profit is and divide by sales. Then you will find a percentage here. That you will use as your markup percentage or gross profit percentage or whatever they call it. So markup percentage, that's how you calculate it. Or gross profit percentage, that's how you calculate it. You take whatever is the markup or the gross profit, divide by sales, you will find a percentage. That is your gross profit and or your markup percentage. So I'm showing the difficult one. The perpetual inventory system is simple and straightforward. This is the difficult one, is the periodic inventory system. Just that here the easier part is that majority of the time we'll give you inventory. We'll tell you that the stock count was conducted and these units were found and these units were not found, etc. etc. Before we move on to the next section, is there anyone who has a question here on the gross profit and markup? The markup and the cost of sales. Let's see by the raise of hands. Let's move over to the most important part of unit number 6. In the interest of time, we're not going to do everything here, but we'll only do 2 difficult transactions, unless if someone is saying they've done the tutorial and they have a specific question that they found to be challenging. But before we go to the questions, there is this item which I want to show you, this slide which I want to show you, and I think is the most important slide for today. This is the most important slide for today. If you were not listening or you failed to grab everything else for the past 1 hour 40 minutes that we've been on, this is the section which you must make sure that you grab. I've just summarized these 6 books in one slide. So here we have those subsidiary journal books that we have been teaching from beginning up until now, of which there are there are 7 in total. They're not 6. There are 7 in total. Of which what going through the discussion forum for this section, I've noted that there are people who still struggle with determining which book am I going to use for what. Of which this slide summarizes exactly that. I hope and I am praying that all of us, when we live here, we understand which book do we use for what. Of which I will start with the structure here. The structure here on top, we're having the purchasing when we are buying things, or when we are purchasing inventory in the main. Selling when we are selling inventory in the main. Purchasing is when we are purchasing the inventory, and selling is when we are selling the inventory. And are we purchasing and or selling for cash or for credit? Are we purchasing and or selling for cash or for credit? And when we are retaining those items, of course. So the logic here is that when we are purchasing inventory for cash, we record our transactions in the cash purchasing journal. Cash purchasing journal. When we are purchasing inventory for cash, we record our inventory in the cash purchasing journal. And when we are purchasing inventory on credit, we will record our transaction in the purchasing journal. I think I used the wrong words here. This is a cash payment journal. When we are purchasing on credit, we are using the purchases journal. When we are purchasing on cash, cash payment journal. When we are purchasing on credit, purchases journal. When we are purchasing on cash, cash payment journal. Cash payment journal is when we are buying or purchasing the inventory on credit. Let's go to selling. When we are selling for cash, it's cash receipts journal. When we are selling for cash, it's cash receipts journal, meaning we are receiving cash from the clients or from the customers. Cash receipts journal. When we are selling on credit, is sales journal. When we are selling on credit, it's sales journal. Credit means someone didn't give you money immediately; they will pay later. So it's when we are selling on credit, it's sales journal. And when we are returning, majority of the time I've seen we assume that we are retaining things that were bought on credit. When we are retaining, the purchases return journal is what we have used. If we are returning inventory to the supplier that we bought from the supplier, the purchases returns journal is what we use. And when we are returning things that we have bought, things that when our customers are returning things that they've bought from us, we use the sales returns journal. Sales returns journal when our customers are returning things that they've bought from us. Sales returns journal. 10 transactions that are not the purchasing on cash on credit, and they're not the selling on cash on credit, and they're not the returning of inventory, and they're not the returning of what our clients have done. Those that do not fit any of the six items above, they will then go to the general journal. So the general journal will use it for the items that do not fit any of the descriptions up there. I will repeat because this is very, very, very important. If you master this, you are halfway to pass. When we have purchased inventory for cash, when we have purchased inventory for cash, we will record in the cash payment journal. And when we have purchased inventory on credit, we record in purchasing journal. And when our clients have returned the item, when we return the items that we have bought from our suppliers, we will record in purchases returns journal. Then let's come to the selling part. When we are selling for cash, it's cash receipts journal. When we are selling on credit, it's sales journal. And when our clients are returning things that they have bought from us, it's the sales returns journal. And all other transactions that do not fit any of those descriptions, we record them on the general journal accordingly. Let me ask a question. Is there anyone who still have a challenge on understanding which book to record what transaction? Let's see by the raise of hands.
Sounds it's a lot of information
Have
to
done. Those
grasp.
that do not fit any of the six items
And,
above, they will then go to the general.
and
Yes,
I've listened
continue.
to, yes, I've listened to what so he's saying what is uncertain, where it needs to be recorded. But I wanted to know regarding the books is referring, is it within the learning units? Oh, I'm lost
Yes, it's
because I
on
know
learning
there's
unit number 6. Yes,
number 6.
yes.
Okay, I will go to through that one because I haven't got that far. I'm only at learning unit 5.
Okay, please go through it. When you are done, try to have a look at that slide and see if it makes sense in terms of trying to logically map it in your mind on what 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 is the reason behind the determination of which book to use. Okay, Lisa D.
Okay, so it's not a difficulty with the journals per se. I just wanted to ask that if possible, would it be possible to have it that when you present the dummy questions, to present them in a format that looks similar to the way it's presented in our tests, assignments, and exams? Because most of the time it's easy now when we do it, it's easy to understand. But then I find that when I get to the exam, the way that they present the journals and everything looks totally different, so I get confused. It might be a bit of a big question.
Okay, yeah, but most of the time they give you those what do you call the invoices and the receipts.
Yeah,
We're just
makase,
we're just extracting the figures from that whole big document.
ish makase, yes,
But I do get your point. We'll see how can we how can we accommodate. I do get your point. I do get your point.
okay,
Thanks,
thank you, sir.
thanks, Lisedi. Okay. Um, let's continue. I hope we're all on the same page. I want us to quickly do the. I don't think we'll be able to do all. In fact, we're not going to do all the this exemplar questions uh, in the session. However, I want us to look at just the two difficult ones, or maybe before the two difficult ones, someone who can just tell us who has done the tutorial, just to tell us from one up until from 3 up until 7, as to which of the three books are we going to use. Number 3, we have purchased something on credit. Number 4, we purchased something on credit as well. Which books are we going to use on those? Let's see by the raise of hands. From number 3 to number 7. Puselots will do from number 9 up until 12. Patu will do from 3 to 7. Patu, number 3, we have bought Andy on credit. Which book are we going to use?
So I'm gonna try. So
Mhm.
that one I think is gonna be credit purchase journal. That one is gonna be 3 is gonna be purchase journal, and
I agree
then
with you. And
and
4,
then
we
the
have bought another one on credit.
is gonna be purchase journal.
And then the number 5, we have
Number
returned the damaged ones that we bought from a supplier.
so we're gonna use the return journal, but it's CRJ. We're gonna use the CRJ for number 5. I don't know if it's
Why
Prince.
R is for what we have received. We're dealing with what we have sold. I mean, what we have purchased here. It's still purchases returns. It's oh yeah. I hear what you're saying. Yeah,
Yes.
yeah. Purchases returns. Yeah, purchase returns
And
journal.
then we sold number 6, we sold handy Andy on credit. It's gonna be so selling journal. Selling
Yes,
journal or sales journal. You're gonna use that one.
sales journal. Yes, that's the correct
Yes,
one.
so
And
sales
number
journal.
7, we have
Cleaning.
rendered the service on credit.
It's gonna be the same as the
Sales
previous
journal.
one.
I fully
Sales
agree
journal.
with you. Then you are understanding it better. Um, Puseleto, we said we will do number 8 up until number 12. Number 8, we have issued a credit note for the expired handy Andes that we sold to someone,
Okay, it
meaning
says
someone
issue.
returned what they have bought from us.
Okay, so it will be she said issued a credit note to J. Jason for expired handy MDs returned.
Yes.
So that will be let me see issued. So JJ is a debtor, right? J Jason.
Yes. It's a debtor. It's our customer.
Oh, so he returned the goods. So it will be CJ, no? The book that we record the transaction on, the cash journal, and then number
Cash.
huh?
What is? Hey, hang
Oh,
on there. Hang on there. When someone has returned the handy Andes that they have bought from us on credit, what is cash there? Can you see what I'm saying?
Yeah, I can say,
This
but
J
I think I'm
Johnson has bought some expired handy Andes from us, and then they've returned them. There is no cash, right?
mm,
And they're
yes,
retaining, right?
yes.
So meaning um, um, we are going to use the sales returns journal on that one. And then the next one, which is number 9, the we have purchased inventory, which is the vanishes on credit, sorry, on cash from Lever Brothers. We have purchased for cash. Which book are we using?
CPJ,
Which is
cash, pay, purchase journal.
sorry, it's cash payment journal. Sorry, I was making a mistake when
Yes,
I
cash
cash on
payment.
yeah, cash payment journal.
Okay. And then number 10, it says sold handy on cash, which is
So we sold handy to the customer on cash. Which one are we going to use?
it's CRJ, cash receipt journal.
I agree with you 100%. And then the next one, they say our uh, our supplier charged us 10% interest on account balance. Which one are we going to use? Did we buy anything there?
And
Or did
no,
we sell anything there?
yeah, I think
What are we
it says
selling?
Ferguson Limited, charge
They charged
BSC
us
net
interest.
10%
Yeah,
interest.
on the account balance. Yeah. So our supplier was charged us interest of 10%. Did you buy or sell anything there?
No, we did
So
not
this
buy.
transaction does not fit in on any of those, and we didn't return anything. Does not fit on any of those. And where do you record this?
General journal.
That's 100%. And the last one, it says error was discovered um, that Ferguson Limited actually charges 5% interest, not 10% as previously recorded. Where would you record this transaction? They're saying just the above one, 10% was wrong. The correct one is 5%. Where would you record that?
General journal also.
100%. I fully agree with you. So I think from number 1 up until number 10, they're all fairly simple, colleagues. We're not going to look at them in the last remaining 3 minutes. The cash receipts journal transactions, you are just going to record them on the cash receipts journal. We have all seen how it looks on the books. It's just a matter of literally recording the amounts inside there. And remember, the VAT, how we calculated it, the principles are still the same. The cash payment journal, we still do the same. The purchases journal, we still do the same. However, I should alert you that the purchase returns, the sales journal, where is it? The sales journal, um, the sales journal looks slightly different on the perpetual inventory system and the periodic inventory system, and the main difference um, is the cost of sales column. The very same goes to the purchases journal, slightly different on perpetual inventory system and the periodic inventory system, of which you should note that. Then I want us to close by looking at the two transactions. Let's start with number 11. Let's see by the raise of hands. Who wants to tell us? We've already agreed that we are recording this on the general journal, the 828 rands interest that the suppliers charge us. Who wants to tell us what are we going to, what are we going to debit and what are we going to credit on the general ledger? Let's see by the raise of hands. Sorry, on the general journal. Let's see by the raise of hands. Uh, Lavaine, are you still at all the ends, or is it the new one? Do you want to tell us when we have been charged 800 rands interest, how are we recording it? What are we debiting and what are we crediting?
Okay, can I try? So on
Yes,
the
please.
cash, yeah, on the general channel, we will
Mm-hmm.
debit the interest expense.
Mm-hmm.
That's it. And then we will credit the account payable or yeah, account payable.
Trade payables.
Yeah, or trade payables, yeah.
Sometimes interest they're called finance cost. Don't be fooled by the names. They mean exactly the same. And payables, most of the time we will also put the name of the creditor as well, which was 824 rands, I think. Uh, sorry, 828 rands. 828 rands. And then let's go to the next transaction, the last one, which says um, actually the 10% or that 824 was not correct. Actually, the interest was supposed to be charged uh, uh, at 5%, meaning instead of them charging us 828, they were supposed to have charged us 414. Instead of them charging us interest of 824, they were supposed to charge us 414. Who wants to give it a try on how do we record that on the general ledger? We've already agreed. The part 2 has already told us that it must go to the general ledger and we've agreed. They're saying this 828 actually is not correct. It was supposed to be 414. How do we record this 414? Puseletso, your hand is still up. Do you want to give it a try?
Okay, so it will be like this. So since they made an error, it means we will debit the trade payables and credit the finance cost.
By how
As they
much?
made the error. The 414, if I'm not mistaken.
Okay. And then your case will be closed.
Mm.
Okay. I agree with that. That is how you do it. But however, what you are doing now can be very confusing. So in order to avoid the confusion, what the only principle I wanted to show you was that first thing first, whenever they say this transaction had an error, please go and reverse that transaction first. After reversing that transaction, then record the correct transaction. So meaning what you're going to do, you're going to reverse what you have done here, which you are going to debit the trade payables with the 828, that is the correct amount, and then you are going to credit the finance cost or the interest with the 828. You have reversed the transaction which you have recorded. Then you come and record the correct transaction. The correct transaction, we said the problem is the amount, which was 414 instead of 828. So you come and record the correct amount. Please, 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 please take these principles and live by it. Of course, the mathematicians, they can go and say 10% minus 5% is 5%, and they calculate the 5% difference and debit and credit. Yeah, it will give you the right amount, but I don't recommend that, more especially at first level, because it can be very confusing. What do? You reverse what was done wrong and record the correct amount. And lastly, lastly, we have an assessment which is going to happen. I will show the slide now. We have an assessment which is going to open on 21 August, and it's going to close on 25 August. And that assessment will be covering everything that we have done from unit number 1 up until unit number 7. So let's go and do it. And next week we're not Saturday. We're not going to have a class because we're giving chance for those who might not have had enough time to do the assessment during the week to be able to do it. And the assessment constitutes 20% towards your year mark in that regard. So let's all go and do it, and all the best. Colleagues, thank you so much. We'll meet again on 30 August. Sorry, am I right?
Thank you, sir.
Yes. Yes, on 30 August. We'll meet again on 30 August, where we'll look
Yes.
at unit number 8 and 9, which will be focusing on the bank reconciliation statements and the trial balance in the main. And those are the easier parts of accounting, more especially the trial balance, because you're just consolidating everything that we have done into one place. And the bank reconciliation is just zooming into one aspect, which is the bank account, the money paid and the money received, which becomes much more easier. So, colleagues, during the week on Thursday, I will do the slides for next week's tutorial. Please, go and after May Nyanga has published the slides and the Excel sheets, go and try and attempt to do those tutorial, so that when we come into the class, we only zoom in and focus on what you have found to be most difficult on the assessment. Thank you so much, colleagues, and all the best with the during the week and the next Saturday's assessment. Thank you. We will end here.
Thank you, sir.